So my key industrial picks on a 12-month view are Maas Group, People Infrastructure, Alliance Aviation. And then on the gaming side, it's Tabcorp, and we also have a positive view still on Bluebet. Given I've covered off on Alliance recently, I won't go through that investment case again today, but I'll kick straight off with Maas Group. We've recently upgraded Maas back to an ad rating. We do think the recent pullback provides a good entry point for investors to start accumulating the stock. I think there's probably a little bit of patience required in the near term as the placement's digested, but with FY21 guidance recently reiterated, we do see low earnings risk heading into its result. We do expect the outlook commentary will be positive, and it should start to build investor confidence in that very strong FY22 growth outlook for the group. So as a reminder, we forecast FY22 EBITDA of $118 million. That's up 57% year on year. That reflects a combination of 28% organic growth and then 29% from its recently completed acquisitions. With the result, also the interesting comments on the M&A pipeline, with the company obviously retaining significant balance sheet capacity to pursue further acquisition opportunities following the $79 million placement. So Maas trading on a reasonable valuation with a strong growth outlook and balance sheet optionality. We still think there remains a compelling investment case there. Turning next to People Infrastructure, given the strong recovery in Australia's labour market over the second half of FY21, we sit at the top end of guidance. We do believe there's potential upside risk to that forecast also. Obviously the recent lockdowns have created some near-term uncertainty and could temper what we previously expected to be, quite bullish outlook comments. We don't think the Sydney lockdowns will have a material impact on the business at this stage, and we obviously are cognizant of that Queensland and Victoria could enter in and out of sporadic lockdowns over the next 4 to 6 months. I guess we would highlight that PPE does operate a diversified business model across varying geographies and industries, and we'd also expect the market will look through any short-term impacts that could arise, with obviously the labour market bouncing back very quickly after previous lockdowns. Management, again, have also flagged over $50 million in balance sheet capacity to pursue further M&A opportunities. We do expect its next targets will be the high-quality health and community and IT verticals, which the market tends to place a greater premium on. So People Infrastructure, I think stock's currently trading on around 13 times FY22. We do think it can re-rate to 15 to 16 times as the market gains confidence in that growth outlook, again with further upside from accretive M&A. Wagner's next. We do probably have a slightly more cautious near-term view heading into the result. We're comfortable with the FY21 result itself. We probably expected some slight upside risk to our FY21 EBIT forecast of $23 million. However, based on the work the group secured to date and some likely additional cost investment, we just think FY22 consensus EBIT at $32.3 million is too high and will need to be revised lower. So for context, we're at the bottom of the market with EBIT of $26.5 million. It's possible some further major project works probably needed to hit that number. So in FY22, I guess we do expect Wagner's will look to increase its level of investment in EFC and also to support its US CFT expansion, which probably limit the extent of FY22 earnings growth. Obviously, the investment in that new gen part of the business is important to support the company's long-term growth initiatives. So I just think the messaging of that new gen investment will be important, with the market likely to look through it, provided I think that management can illustrate some solid confidence and progress in securing an external EFC investor over the next 6 months. Provided an EFC investment is secured, we would expect the market to start to look at the business on a sum of the parts basis, where there still does remain attractive valuation upside from current levels. So in the short term, our caution just reflects a bit of uncertainty as how the market will react to FY22 consensus downgrades. Arguably some of this is already in the price with the stock sort of derating over the last couple of months and probably trading sideways over the last sort of 6 months. Turn to Tabcorp quickly. Obviously, we added this to our best ideas list. We don't necessarily see the FY21 result itself as a key stock. I think the downs would have likely slowed the extent of the FY22 recovery consensus had assumed for the wagering, media and gaming services business units. And we do continue to view the risk-reward profile for this investment as asymmetrically skewed to the upside over the next 12 months as the merger has progressed. So obviously, as you know, the crux of our investment view here is that we do expect the market will re-rate the high-quality infrastructure like lotteries and Keno's business, which we think can trade on a standalone basis of between 16 to 20 times EBITDA. The outlook for the wagering gaming co is more challenging, but we do expect the recent proposals that they have received for those businesses should continue to provide a level of ongoing valuation support. In this environment, we probably can't rule out the possibility of further corporate interest while the demerger's progressed, and Tabcorp has noted it does remain open to considering further proposals. And then just finally on Bluebet, clearly the stock's performed very strongly since IPO, but it has had a sharp pullback over the last week following PointsBet's sort of $400 million capital raising. So you've probably seen, that incremental money maybe switching out of Bluebet or just going into PointsBet on weakness. PointsBet's obviously probably derated itself in the near term, which could sort of weigh on Bluebet, but we do retain a positive view on that stock. We do see a number of key catalysts coming up in coming months. That includes a strong trading update with the group's August result, a decision on its Virginia application, most likely over the first half of FY22. There's going to be the launch of its refreshed website and mobile apps, and then they're going to launch the new marketing campaign too, which will coincide with the spring racing carnival and NRL and AFL final series. So, given the group's strong FY21 active customer beat, which came in, I think, 16% of prospectus forecasts, and then the likely benefit they would have seen from, probably strong customer engagement on their platform during this lockdown period, we think it's possible calendar 21 prospectus forecasts could also be upgraded as the first half progresses. So look, in summary, I'll finish there, just reiterating sort of key picks on a 12-month view of Maas Group, People Infrastructure, Alliance Aviation and Tabcorp. Happy to keep chipping away at Bluebet here, particularly on days of weakness. And then we've just flagged a little bit of short-term caution on Wagners with FY22 consensus downgrades likely post the result, but still valuation upside potential through securing an EFC investor over the next 6 months.